Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for May 10th of 2026. Well, happy Mother's Day to all the moms out there. As we get started in the chart pack this week, let's talk about consumer sentiment and where that sits. We have talked about this in the past. Sentiment has been weak and it seems to be getting weaker. The longer that we go with higher prices at the pump, higher prices at the supermarket, particularly for the lower income cohorts, that has been a problem. You can see here in this Gallup poll that the percentage of those who feel like their financial situation is getting better in the green here. You can see that that's going down at the same time that we have the percentage of those who feel it's getting worse is moving higher. And this just represents staying the same, which is going down. So we're seeing a greater share of people that are not only just impacted, but obviously impacted in an adverse way. Another Gallup poll here, we have essentially an expectation on retirement. So you've got basically about 82% of the population that are in retirement right now feel like they have enough money to live comfortably. And unfortunately, however, the percentage of non-retirees that feel like they're going to be in the same boat is far lower. It's less than half of those non-retirees expect to be able to live comfortably in retirement. On this chart, we have the University of Michigan Consumer Sentiment Index at a fresh low down here. You can see 48.2. And this goes back quite a ways, back to 1980, and you can see that we've never had a reading this low. If you don't believe the consumer sentiment number from the University of Michigan, here is something else that I offer up to you from the Morning Consult, and this is a daily index of consumer sentiment by income cohort here. This would be the upper income. And you can see like basically all income levels are witnessing a decline of consumer sentiment. And obviously the pain is being most felt by those that are under $50,000 of annual income. You could argue maybe that the upper income folks are witnessing a little bit better sentiment right now, but overall you can see that from these levels that from where we ascended after the 2022 inflation scare here, that we basically recovered a lot of lost ground, and that has now eroded in just about every cohort. We'll talk about the economic growth estimates. As we sit here in May, we're kind of like saddled right in the middle of the second quarter. And a lot of estimates are being generated now based on what we're seeing in the real data that's coming out. Now, blue represents the blue chip consensus. So this line right here represents the consensus. This is the range of the top 10 and bottom 10 estimates out there from major economic forecasters. And out here sits the Atlanta Fed GDP Now estimate. And as we'll see in a moment, estimates for the year are actually pretty robust. And I think this is what's fueling this positive sentiment in the market, right? And we just saw that economic and individual sentiment is pretty low, but market sentiment is actually pretty high. And it's being fueled by estimates for higher GDP growth. And Atlanta Fed has historically done a very good job of forecasting. So, and as we'll see in a second, we're really looking for a fairly good year that nobody, I think, would have predicted 6 months ago. This chart from Bank of America, Merrill Lynch, we have estimates for nominal GDP growth. You can see here in the blue that we've got 5.5% estimated for this year. That comes off a year that we did almost 5% in nominal growth. That's not real growth, mind you, but that's nominal growth. And you can see that that's tracking probably better. When the estimates first started being released, we were looking at something that was closer to 4. So quite a bit of optimism has kind of been built into the market over the last 6 to 9 months. As we look over here, here's a consensus forecast For earnings per share growth in 2026, that's now at 20%. We've shown you some charts on that over the last month or so, and estimates have actually gone up during the Iran conflict, not down, which is somewhat unusual in the sense that usually when you have some kind of a conflict that is protracted like this Iranian conflict is, that you'd have estimates that would at best move sideways, if not down, because of the anxiety and the uncertainty. But indeed, those estimates have gone up. That has helped to fuel some of these estimates of higher economic growth in 2026. But again, a lot can happen between now and then. Well, I always like to look in longer term trends and certainly look at rates of growth, which is kind of like a second derivative of sorts on what's actually going on. If you look over time, some of these data series are really compelling, and this is one of those. This is looking at nominal GDP, which we just looked at with those estimates of 5.5% for 2026. This is going back to 1960 and following the track, and this is really kind of for a while, it was kind of a geometric rise, but a relatively slow geometric rise. But after COVID, we had an acceleration. And so the argument here is that with the estimates of GDP at the end of 2027, which again, about 18 months from now, that from that 2020 low, we will have seen a 75% increase in nominal GDP, which is, when you really think about it, again, it's, 27 years, but it is an astounding rate of growth when you really think about it in the aggregate. And this chart tells you that the rate of acceleration has picked up since that pandemic. We talk about the share of the economy. Everyone's excited about these estimates heading into the latter half of 2026. However, I think it's important to realize how important the government really is in those numbers. And you can see, 1930, you've got the World War II, and even more modern. Let's just take it from the beginning of this particular century. Federal spending was about 15%. Now it's about 20%. And so, anyone who doesn't say that government spending isn't important to the economy is just not giving you an accurate statement, because this is one of the key components of economic growth is, you've got consumption, you've got investment, you've got government spending, and net trade are really the four drivers of the economy. And so government, as you can see, over a long period of time has become more and more important in that equation. Composition of federal spending, not too surprisingly, we've got transfer payments to individuals at the expense of all of these other categories, including national defense. Interest is something that we're going to watch, because we have just seen this little inflection point here where interest payments have now eclipsed national defense spending, and that's because of higher rates. At the same time that you're squeezing out all other federal spending, and basically where that was 1965 to 1980, that was something like 20%, and you had a lot more discretion in the federal budget, and that was a time where there was more agreement amongst the parties, and you had balanced budgets and things like that, and we haven't seen any of that really lately. Particularly over the last 20 years or so, and part of that is because there's just simply less room to spend. Now, that doesn't mean that they're going to continue to expand the deficit, which they certainly have been, and that has very, I think, consequential long-term implications. But again, the big story here is that you've got transfer payment to individuals that is driving up federal spending. Now, when you break that down, those transfer payments, you can see very clearly that Medicare and medical care in general is the key driver. Now, Social Security is also a key driver, and a lot's been made over the years over when the trust fund for Social Security is going to exhaust itself, and that's still on the horizon. There are gimmicks in terms of how you can shore that up, kind of mechanically through levers that you can pull at the federal level. But in any case, it's clear, again, on this long-term trend line, that you just look at it from here, like almost at the turn of the century, and it was like 35%. Now we're looking at something that's pushing 50% of total federal payments for individuals in the category of healthcare, and I don't see that changing anytime soon. Here's federal government outlays, as I was pointing to before. This chart does a really good job of showing you the inflection point that I mentioned. Now we have more interest cost on the debt. Again, we have more debt out there because we're running pretty substantial deficits, and the accumulation of that interest on that higher level of debt has now eclipsed defense spending. Something else that has eclipsed defense spending is the AI capital spending. This is something that really caught my eye. This is from Morgan Stanley's research, but back in 2025, that was not the case. We basically, as a percent of GDP, had 1.5% of GDP on capital spending. Again, these are data centers. This is computer equipment. These are chips. These are chips being semiconductors, and these are all the things related to the growth of artificial intelligence in our economy. This year, it looks like it's going to be close, but defense spending will continue to exceed that amount, even if it is anticipated to be less year over year. Flat defense spending in 27. However, what we're getting from all these hyperscalers is a fairly expansive spending program on data centers and everything else that I just mentioned. And that is estimated to basically be about 3.25% of GDP, eclipsing national defense. Now we will talk about oil for a second. We have Mohammed El-Erian, a prominent economist. Read a piece from him. This is something that he cited and several others have cited. Really talking about oil inventories. And, just as I literally am recording this, Trump has rejected, here on Sunday afternoon, has rejected the Iranian proposal. So yet again, we're going to go into a new week with a weak market because of, some, pivoting, political pivoting on the part of one government or another. And what it's doing, though, is because you've got basically embargoes, and you have barricades, and you have these things going on, which is disrupting supply, and it's taking supply out of the market. And so here's where we were at the beginning, and this is basically visible oil inventories in billions of barrels, and so that has continued to come down. And so the argument is that we can avoid a recession. Again, we just got through talking about, estimates for GDP being fairly robust, earnings estimates being really good. People they're not focusing on this, but Mohammed El-Erian's point is we get to September and then we get to a point where you literally have to, you're going to have to slow pipelines, and, when you're not running refineries at a pretty high output level, at a high utilization level, they don't run efficiently at all. And so this becomes a real problem if we get down to an operational level where we just simply don't have the crude to run through our system. Couple of observations, though. This is from Piper Sandler and Morgan Stanley here. You can see that this is just comparing, what's going on right now to the early 90s, and the 1990, 91 oil shock, which corresponded to some degree with the Iraqi invasion of Kuwait, which I remember quite well. There are some similarities, but there are some stark differences. And here's, for those who are paying attention to, oil industry dynamics and their impact on the overall economy, I think this is pretty telling. So, consumer exposure, this is, we had a higher intensity of gasoline spending than we do now. You talk about the economic backdrop. The economy right now is strong. It was weak back then, and you had the Institute for Supply Management, production indices falling, and right now they're rising. Economic data has surprised consistently on the upside over the last several months. And then you obviously have a difference in jobless claims. Corporate sector, technology is very strong, and corporate profit margins are a lot higher than they were back at that point in time. And then the energy structure, clearly with shale oil, we have become a net exporter, and we do a much better job of controlling our own destiny here. And financial conditions, we were just emerging from the S&L crisis, the savings and loan crisis, back in 1990, 91, and we have a very liquid and fairly robust system now. And policy-wise, you can make some arguments here, but this is a point where taxes were in the process of rising, but we have a huge fiscal spend here that's driving, as I mentioned before, those big deficits, which are driving that interest or the debt burden and the interest burden up as a percent of GDP. Couple of items of note on the commodity side. We've got steel right here. This is pretty amazing to see this. So when you think about any capital project out there that requires steel, this is going to be important. And cost escalation, when you think about it, and you look at, the geometric rise in this is a pretty astounding rate of growth. Now, this is essentially, the steel ETF, but it also is a parallel to steel prices. So this is basically a tracking security, if you will, for steel. So when you think about, the commodity basket, and you do have some things that are moving the other way, like maybe natural gas, but you have a lot of the construction and industrial metals that are moving higher, and steel is just one of those. Now we have cattle. So anybody who's tried to buy a brisket, which I have over the last several weeks, your eyes almost pop out of your head when you realize how expensive they are. This is a chart Y. I mean, we have essentially, had a compounded rate of growth. I mean, this is literally 500% rise in cattle prices. Now, this is live cattle, so this is a proxy for everything that you see packaged at your grocery store. So just think about, this price transmitting through the production channel where you've got the packers, and then you get down to your local supermarket, and so everything filters through the chain here, and this is a big reason. And again, this is not way back when. This is 2022, so this has all happened within a fairly short period of time. Now we'll switch and talk about monetary policy. And so here we've got a developed market. Central banks now are really in a hiking mode. And so this is something that's really changed here. Now, again, we've got a relatively strong economic backdrop here in the States. It's a little weaker, but not necessarily bad overseas, particularly in Europe, and Europe is, had been expected to be weaker, but we strangely find ourselves, not even talking about rate cuts anymore. And I think those are really all off the table, even though Kevin Warsh is coming to the Fed. He just doesn't have the votes on the 14-member open market committee to get that done. And in fact, we had 4 dissensions from the latest Fed rate decision, which are pretty much putting a stake in the ground that we will not have rate cuts. And what's interesting here is you got developed market central banks that are now net hikers, if you put it that way. So, there's a greater number that are hiking than there are lowering rates. And emerging markets, different story, but the calculus is the same. It's changing. And I think as we get a little bit farther into the year, again, if we see more oil price transmission through the economy and, prices be stubbornly high, then you will definitely see a preponderance of central banks probably in a hiking mode. Now we'll switch gears, talk about home prices. I see this, you know, continue to channel. This is very interesting. So you have more incentives. Not that you have inventory. There's some markets that are actually fairly normal, in terms of inventory on the market. But again, new homes are far less impactful to the market than the used home market is. But new homes still matter, and there's still a lot of benefit to the economy from new construction. It goes all the way down from labor to materials, so on and so forth. And you can see here, new home prices took a fairly strong step down here in the last month, and you can see in the caption here, down about 6% from a year ago, and that's the lowest point that we've seen since 2021. That is despite the fact that we have seen overall a decline in interest rates. This is the 30-year fixed mortgage rate, which had been trending down until we got to the Iran conflict. I was about to say Iranian, but I got stuck in the middle there. So the Iranian conflict then moved interest rates higher because we had the fear of inflation, and so you can see that basically we're about 6.3% on the 30-year fixed, and then 15-year is looking close to 5.75. Rent inflation continues to come down. It is still positive on a national level, but it continues its deceleration. Here we have labor productivity, which we're watching for those inflection signs of AI, and this is a quarterly data series that goes back pretty far, and so it's proven to be quite noisy. But we have taken a downturn. So I think we're just on the forefront of seeing the real productivity gains coming out of AI. And what's very interesting here, and these captions do a good job of kind of like explaining these little humps here and dips. But the net of all of it is that we are tracking, despite all this noise here, I mean, we're tracking ahead of trend line when it comes to non-farm productivity. And so any AI boost will help to move that even farther above the curve. We have unit labor costs, which are continuing to come down. This is monthly data, so you can see these individual data points in the gray bars, and the blue represents a year-over-year trend. And as you can see here, really for I'd say the last 6 months or so, we've seen that in a downtrend. And also, when you look at wage growth, this is the Goldman Sachs wage tracker on a year-over-year basis. The blue represents that downtrend that I was talking about. Compensation per hour is also following, as well as the number when you put it on a quarter-over-quarter basis and you annualize that. You can see all of those metrics moving lower, yet still positive. This is another one of those slides from BCA that really caught my attention here, and for its predictive power. So when you look at this chart, it goes all the way back to 1970, and there's a really tight relationship between these two data series here. And there's an argument that comes out of this analysis from BCA's point of view. So you're plotting in this darker line the unemployment rate, and that's pretty well understood. Now, this other line is a measure of kind of consumer confidence, and so this is when you look at this right, it's on the right axis here when these numbers are kind of inverted. At the same time, unemployment rate here, and so we do know that unemployment rate is moving higher, not as significantly so, but it is moving higher, and so So we monitor that in the dark green line here. Now, what's really interesting is in this plot where you've got jobs that are plentiful minus the ones that are hard to get. And as that jobs that are hard to get gets to be a larger number, this data series gets to be a lower number. And it tracks really, really well with unemployment rate. And so the argument here from BCA is that going back to 1970, you have never seen a time where both of these are moving together in an upward fashion where we have not had a recession. Now, the probabilities of recession are still fairly low, and I'd argue that they were, gone up from like 20, 25 to like 35, say, but they're not extraordinarily high yet. But this has a lot of predictive power, and so, again, to the notion of being eyes wide open because the data tells us that we should. That's why I offer this chart from BCA, who does a really good job of mapping these trend lines out and finding the data series that don't have this kind of like the serial correlation, but that have that high overall correlation that's not dependent on each other. On this slide, we have some inflation measures. We have the core CPI, Consumer Price Index, as well as the core PCE, which is personal consumption expenditures. And you will note here coming from 2022, which is our peak of inflation, that has come down. And when we think about the core CPI here, now that has continued to move lower. However, we've seen an uptick in the core PCE here, and that's very unusual, basically over the last 6 months or so. And that's very unusual to see because there is a relatively strong relationship between these two data series. And so I think whenever you see this kind of divergence in a data series, in two data series that have a pretty high rate of correlation, either, you ask yourself, either has the fundamental backdrop of these data series changed, or are you going to have some type of intersection of these at some point? Like, do they just revert back to the mean of wherever these two are trending? And that's usually the case, that something gives here. Either this one goes up or that one goes down. And again, we're in this really awkward period of inflation where we could have higher than normal inflation for a while. Again, where we are here, I mean, we're looking at close to 3%, 2.5%. That's above where we were before. This is the Fed's target. We're clearly not there yet. And so do we remain higher and then wind up having lower growth than what everyone expects right now? And we just don't know. And I think the little comment that I was making with regard to the oil markets, that could influence this down the road. Now, if we get to this point in September that I mentioned in that last chart that we looked at on oil, that where those inventories get to that critical level, I mean, you could literally see $150 a barrel oil or $175 barrel oil. And if that lasts for more than a couple of weeks, then you're going to see $6 at the pump, and you're going to see a much worsening attitude there, and you're going to see this continue to move higher. This chart kind of speaks to something that I've been following personally for some time here, and that's the notion of having positive real wages. And I felt like that had been important to the equation of the continuation of consumer spending and overall consumption. And with the inflation that surged after the Iranian conflict began, I began to worry, is that going to remain the case? And so you've got wage growth, which we have been looking at as continuing to go down, but at the same time, inflation's moving higher. So will be creating a situation, if this persists, that you're going to have negative real wage growth, which is coming at a terrible time in which the price deck is higher, as I've said, for the lower income folks, and it creates a more problematic scenario for economic growth unless this reverses itself. Something else that caught my eye here, we've got basically information technology, which is going through the roof. We know that there's a high concentration of technology within the index. That's well documented. At the same time, however, we see payrolls that are tied to technology continue to move lower, and in some cases, dramatically lower. And so you can see that this, oddly enough, has kind of a negative correlation with each other, and with this inflection point around 2018 or so. But some of this is productivity, but this is also very telling that there's a pretty high concentration in areas that are not labor intensive. High concentration of increasing wealth and increasing value in the technology sector, like I said, in areas that are not labor intensive. Brent crude, we've been watching this. This kind of moves around, I suspect, on the news of Trump's announcement that the Iranian proposal did not meet his expectations, and the market's falling in pre-market tonight. That we'll see crude move higher. And what I was saying before is that if you get to a situation in September where we're at the most critical levels of oil in the production system, where you get pipeline and you get refinery disruptions, I think you could see this closer to 150 for at least a period of time, and that's kind of that will change a lot of the slides with regard to the oil shock and whatnot. And I really hope that we don't get there. Obviously, the market nor the economic forecasters believe we will. But then again, most of us did not think that the Iranian conflict would have lasted this long as it has. Now we'll talk about the equity and the fixed income markets. Here we have yet another chart that I find particularly helpful when you want to put things into perspective. And it's really easy to get caught up in the moment and kind of focus on the here and the now, when most of investing should be longer term horizons. Here I think is very illustrative of that. When you go back to this time series 1961 and you follow it through to present day, you can see that this is the S&P price index. Very strong upward bias, as we've talked about. There are notable hiccups that come along the way, and they feel extremely painful at the time. But if you have the fortitude and you have the time to wait it out, you can see that they always work themselves out in the end. And just as we saw over the last couple of weeks, that the market spends far more time in bull markets than they do in bear markets. Bull markets are in blue. Bear markets are in this amber color. You can see here that the average duration from 1961 has been 64 months in a bull market and only 14 months in a bear market. Again, bear markets can feel painful because you can see a fairly negative gyration in prices. And it feels really bad at the time, but if you have the intestinal fortitude and the emotional strength to not sell into that pressure, but maintain your diversification and take advantage of opportunities, that again, it always works itself out in the end. And if you go back to the pandemic, we were down, fairly viscerally when the economy shut down, but we were only down for 1 month. Now 2022 was a little bit longer, it was 9 months. But again, we weathered that, and we've had a very strong response since then. Several really good years in the market. So I offer this to you as perspective building that I think continues to drive the point home that diligence and stripping emotion away out of the investing is very, very important to overall long-term success. Here we have some more testaments to long-term investing. Again, if you are diligent and you stay invested and you don't try to get cute or panic, then you can witness some pretty strong returns. Particularly if you get back, if you have the ability, if you're a younger investor and you've got 20, 25, 30 years to invest, you can see how this becomes really parabolic over time. And when you think about like this, a simple rule of 72, that you take your rate of gain and you divide it, or you take 72 and divide by your annual rate of gain, and that tells you how many years it's going to take you to double your money. And you can see here, if you start off with 100,000 with about 11% annualized rate of growth that we have seen since 1928. This is actually a little bit more aggressive than the statistic, which I think is closer to about 10 and a quarter, 10 and a half maybe. But nevertheless, you go out to 7 years and you've already doubled your money. And then, not too long a time frame, you double that money, and then that doubles. And so you can see the power of this. So when if you're a client of ours and you're looking at our probability of outcomes page on our software, and you see the rate of growth, and sometimes it's like, well, am I really going to have that much? Well, if you're diligent in your financial plan and the assets that you have that are invested continue to grow and compound their rate of growth, then absolutely those numbers are realistic. Here we have some anecdotal evidence on some other bubbles that we've seen in the past. It goes all the way back to 1835, and those people that know me just know how much I love these, these oddly, uniquely historical events. But this is the railroad boom when you get to 1835, the 1870s, the 1880s, when railroads comprised a fairly large part of the publicly traded index. And then that obviously corrected, and then you go here, you got the Nifty 50, in the Great Generation. Or excuse me, the Great Society in the 60s, and then that led to Japan as a percent of the All Country World Index, the ACWI from MSCI, and then you've got tech and telecom, and then now we're at we're talking about this AI, this. Well, some people, you can have Mag 7 in one basket, but really the big 10%. So this is basically they're adding the Mag 7 with a few other stocks there, and you've seen that that could be a bubble in and of itself. And so we want to be careful though, in the sense that just most of us will at least remember, have some more recollection over the tech bubble bursting. When these valuations got really stretched, and what did it do to the broader economy? Here we have high beta versus the S&P 500. So really, the riskiest stocks have done well. Meanwhile, low volatility stocks have underperformed the S&P 500, and that's where we've seen a lot of fund flows chasing returns because looks so good. Now, high beta, a lot of these are technology firms, but you have a lot of really strong cash flow firms that are underperforming the index, but they're providing diligent returns and they're providing diligent cash flow, and this is just part of the divergence that we've seen in this economy that has really struggled to maintain any kind of a consistent balance between growth and value. And in fact, we've seen a lot of value stocks that have, even recently have considerably underperformed and, have lost, 5, 10 or more percent of their value. Another one of the more interesting observations that made in the market right now is this represented on this slide, and this is the spread of the S&P 500 earnings yield over the 10-year Treasury. And as you know, with the Iranian conflict, we've seen pressure on fixed income and Treasuries in particular, and so we see yields higher on Treasuries, and we're actually at a point now, very interesting, and this does not happen very often, where Treasury yields are greater than the S&P 500 earnings yields. And you can see that, despite the fact that we've had, earnings increases on the equity side, we've seen prices move much more than that, at a much greater rate than earnings. And so that earnings yield has gone down. And it has actually made equities, ironically, less competitive to fixed income. So anytime you see a situation like this, it's really indicative of the market being stretched a little bit, and also a function of the bond market being under more intense pressure. We talk about concentration risk in the equity markets. This is just a slide from Apollo showing you that the top 10 companies in the S&P 500 now account for over a third of profits, and that's pretty telling. You can see that over time that's been far less, and again, this puts more risk into the equation. Again, you've got a higher concentration of firms overall. The top 10 firms from a market cap standpoint, account for 35 to almost 40% of the index, and that's really kind of almost obnoxiously high, but they're also accounting for an obnoxiously high percent of the S&P 5 profits too. So the moral here is that if something happens with regard to those profits and they unwind, that's going to have a meaningful impact on the S&P 500. We look at sentiment. You've got active investors index looking really bullish. It seems like not too long ago that we were kind of talking about this kind of free fall here. That has reversed itself quite a bit. You look at the individual investors sentiment. Net bearish continues to move down. Bullish moves higher. We find ourselves still in kind of a net positive sentiment from an individual investor standpoint. So both of these are working in concert with each other. Now we have, talking about those earnings, we've got this chart here. This is from Deutsche Bank, and what's really I think amazing here, and again, this is some conjecture on the part of Deutsche Bank, but basically you've got a 90-year trend almost, and where you've increased earnings on average about 6.5% a year, and we're on track to break through this incredibly long trend on the upside, and that's to kind of give you a sense of how really amazing it is to have these earnings increases, these estimate increases. There's a lot of optimism built into those earnings, to the point that if they turn out to be true, if they manifest, it will bump us above that 90-year trend line, which would be pretty phenomenal. To my point about breadth, I mean, we had on that last slide, we talked about, top 10 firms in the S&P 500 account for over a third of earnings. Meanwhile, you've got, the share of S&P 500 firms that are outperforming the index is pretty low relative to history. Again, this goes back to 1990, and we're kind of at that point. So you got a lot of really large and well-heeled horses that are driving the market, but you also have a lot of laggards that are being drug along and really aren't performing nearly as well. Here we have earnings surprises, which I've told you from a growth and inflation surprise. We've had pretty strong data this year, and that has put some pressure on the 10-year yield, which you can see has moved higher, kind of like in the 4.3 range. Again, there's usually a cause and effect here. When you have increased surprises, it tends to increase the inflation expectation. You can see that the rate of increase, or the rate of those surprises, have really turned a whole new leaf in this year to date. So much so that it has caused those rates to move higher. So the last slide here, very interestingly enough, the number of 18-year-olds is at its highest point that it's expected to be at. Then it is expected to go down. Our birth rates are not keeping up, and so we're not at a replacement rate here in the U.S., nor a lot of the developed world, which is going to be a problem in, call it, 30 to 50 years when you're in a net population decline. But here's, when you think about this, you got 18-year-olds at their peak right now. They're going to transmit in the next 20 years into their peak earnings years, but they're not going to be replaced by new 18-year-olds. So when you look out over the longer term horizon, that's when you're really going to have to dig deep into policy initiatives, to help your country move forward. And that will not be my problem or your problem. It will be our children and their children's problem down the road. That's all we have for the chart pack this week. Hope you have a great week, and we'll talk to you again soon.